Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump says he'll speak with Russian President Vladimir Putin on Tuesday as the U.S. continues to push for an end to the war in Ukraine. And Treasury Secretary Scott Bessent saying he's not worried about last week's stock market correction, calling it, quote, normal and healthy. Meanwhile, in China, consumption and industrial production grew faster than expected, marking a positive start to the year amid tariff threats. Lizzy.
Well, good morning, everybody. And it looks like it's going to be a tepid start to the week in terms of European equities. US futures pointing lower, though, off those comments, Kriti, from Scott Bessent saying that correction was healthy. You've got Chinese stocks in the green after the data beat this morning. We wait the policy stimulus announcement later on. Will this she-put rally continue? And then we have oil boosted for a second day. This off the geopolitics. US continuing its unrelenting attacks on the Houthi rebels, but also because of this demand from China. The countdown to the opening trade starts right now.
I'll be speaking to President Putin on Tuesday, and a lot of work's been done over the weekend. We want to see if we can bring that war to an end. Maybe we can, maybe we can't, but I think we have a very good chance.
President Trump speaking on Air Force One a couple of hours ago, talking about the fact that he is now going to be having a discussion with Vladimir Putin on Tuesday. Lizzy, Tuesday is going to be a big day for Europe. You've got those talks taking place. That could be absolutely critical to this process. Plus, we're now looking like we've got the green light for this German vote to go through. A huge spending increase coming at the heart of Europe in terms of defence spending, infrastructure spending. Tuesday looks like it could be a key point for Europe to focus on.
Yes, so that points back to the defence story and to Ukraine, the German vote. But if we focus on where we're at in terms of these Ukraine ceasefire talks, yes, you've had Trump saying that he's going to be speaking to Putin tomorrow. Yes, we may get an announcement on the talks by tomorrow. But actually, you've had Steve Witkoff, the White House Special Envoy, talking to Putin already in Moscow last week. Putin wasn't up for an immediate ceasefire, even though Ukraine was. So you have to ask whether actually this is just Putin stalling for time, trying to advance his position in the war so that he's got a better negotiating hand when the time comes.
I mean, the geopolitics are fascinating here. I don't think 3 years ago we thought we would really hit this moment in the near future as quickly as perhaps we did. Are the markets pricing it in? Do we need to be looking at the commodity impulse? Do we need to be looking at the fund flows? Do we need to be looking at about the ripple effects on the central banking space? I don't know how to think about this from an investor standpoint.
The FT running with a story this weekend talking about the idea that investors are looking to try and re-engage with Russia from an investment point of view, which I think is fascinating and feels kind of early, but I guess probably people are starting to make those moves. So I think that's one investment angle on all of this. But I think the bigger picture is that the situation, even if there were peace, were to likely see Europe spending a great deal more on defence going forward. That's why the Tuesday vote out of Germany is really important. But to your point about, Witkoff's been there, but Putin's not going to announce all the deal with him. He's going to wait for the conversation with Trump, isn't he? And that's going to be really where the messaging is likely to become more clear. Trump was reasonably equivocal, though. He's not, I'm going to get a deal done here. He's like, a deal may or may not come out of this. So even the President of the United States is hedging his bets here, which I think is really interesting in terms of what we're seeing. So the narrative doesn't necessarily kind of end with this Tuesday meeting. There could be further talks. There may be, to your point, a need for further negotiations further down the road. Let's talk about what's happening in China right now. We'll bring some pictures any second now of what is going on. You've got a briefing being held by Chinese officials right now. You can follow this live on your Bloomberg terminal, of course. There's plenty of ways of doing that. There's a live blog that's kicking off. But what we are waiting for here is a clear picture of what the Chinese are going to do on the consumption front. We've had activity data out overnight, generally quite strong. Consumption and industrial data, both quite strong. The market's kind of looked through that, Kriti, and is looking for this meeting here, this announcement here. This is what was flagged on Friday to give us a sense of whether or not the Chinese are really stepping up and going to deliver to boost the consumer, the key kind of area of Chinese weakness right now.
Well, it's a fascinating jump here. I think the estimate was 3.7% on the retail front. We got 4% to your point. And I think it really speaks to this idea of how much more fiscal stimulus can China even afford. They're backstopping the property market. They're backstopping potentially the stock market as well, putting bans on things like short selling, for example. Is this a good enough number for them to say, OK, let's take a beat, before we have an even bigger kind of impulse into the market.
Yeah, and is what they announced today enough to sustain, as I said before, this she-put rally, this idea that actually the administration will do whatever it needs to do to get
it
consumption...
needs to broaden out, though, doesn't it? At the moment, it's really tech-focused. It needs to go beyond that.
It does, and then when it comes to consumption, the experience is that you give subsidies and the impact is short-lived. So how do they make that a sustained boost is the question for this presser we're watching.
Well, there's also an international component here as well, and we keep going back, and the comparisons I see being made back from analyst notes is this kind of China fiscal stimulus similar to what we saw on the back of 2009, for example. That global recovery was in part driven by Chinese kind of infrastructure spending. We're not seeing the same extent this time around, but perhaps we see it show up specifically in Europe to the sectors that are exposed.
I do wonder whether or not there is a better comparison maybe with what the US did post-COVID, i.e. boost the consumer, basically just hand out money, get the consumer spending, try and get the kind of the velocity moving around the economy of money a little bit quicker. So some headlines coming through. Consumer confidence, demand remain relatively weak. The Chinese are recognising the problem. The question is, what are they going to do about it? And remember, all of this, of course, comes pre-tariffs. And the president's been on the plane overnight talking about tariffs. Reciprocal tariffs are coming. That's going to be kind of grit in the gears of global trade, which China relies on.
Absolutely, and that volatility around the tariff trade completely took the U.S. markets, by the way, to correction territory last week. Do we see some sort of rebound? We keep waiting. We had this conversation this morning. Does the Trump put exist anymore? Scott Bessent, of course, talking about this idea that this is normal. Corrections are normal. They're normal. They're healthy. They're fine. Look, this man comes from Wall Street. He's speaking the Wall Street playbook here, that a 10% drop in the markets are nothing to worry about. Does that then put the focus on monetary policy instead?
Is the Powell put still there, basically, is the question you're asking, i.e. is Powell going to reference this market sell-off and talk about his concerns surrounding it? And there should be some risks around it. US consumer spending is driven by the high end. The high end is backstopped by the US stock market. If the high-end consumer starts to wobble, is that necessarily a problem? But I think the Bessent story is interesting, in as much as he was the guardrail. This was the guy from Wall Street who was meant to be kind of keeping Trump on the straight and narrow, but he's full manga now, isn't he? Manga now, isn't he?
So if you haven't got a Trump put, you haven't got a Fed put, you're looking at no guardrails and a free fall for the S&P. Look, you could get a hawkish note out of Powell in this press conference. The forecasts could look pretty stagflationary, a higher inflation forecast, a lower growth outlook. That would leave a pretty horrible taste in the mouth. And then we've got to kind of balance the communications on, yes, saying that the economy is resilient, but also saying we need to be on standby in case you need to do something on the tariff front.
And we're already seeing expectations of that baked into the U.S. market. For example, inflation expectations, I think, at a 22-year high, going back to the UNISH data that we saw on Friday. That, right off the bat, is a big, big red flag. There is still a dislocation right now between the data and what the markets are pricing in. Yields are dropping, not rising.
Yeah. So lots of central banks to watch this week, not just the Fed, but the BOJ, the BOE and the Riksbank as well, all expected to hold. But in the meantime, we've got some breaking news just crossing the terminal in the past couple of seconds, and that is from AstraZeneca, which is looking to buy ESO Biotech for a total value of up to $1 billion. So a bit of M&A there in the pharma space. Yeah,
we'll look forward to seeing how that translates into the market open. Obviously, the AstraZeneca story, a huge one for the FTSE 100. One of the most heavily, I think it might even be the most heavily capped stock on that index. What have we got coming up on the show? We've got some great guests lined up to talk us through how you should be looking at these markets and what is going on around them. Also, Mortier, the Amundi Chief Investment Officer, is going to be joining us a little bit later. Look forward to that conversation. Brian Manell, the CEO and Chairman of the critical minerals mining company TechMet, looking maybe to plant a flag in Ukraine. We talked about this last week. What's in Ukraine in terms of the critical minerals story? And Mark Giannoni, Barclays Chief US Economist, is going to be joining us ahead of a critical week in the US.
Yeah, so we kick off this week with the US retail sales data coming out today. We also have an Nvidia conference happening in San Francisco Monday to Friday. And then tomorrow we have, of course, the German vote on the debt brake, as well as the ZEW data out of Germany as well. Wednesday, as I say, the BOJ decision, the Fed rate decision, and then Thursday, the BOE rate decision, the SMB rate decision, and then we end the week on Friday with Japan CPI. But on that Nvidia conference that's going this week, there is speculation that the CEO, Jensen Huang, is going to announce another iteration of the Blackwell GPU, which of course is kind of necessary to feed the hype post DeepSeek. And if we look at, we've got a chart of how analyst expectations of the long-term EPS growth for Nvidia have been slashed nearly in half since that 2023 kind of peak of AI hype. They really need to inject a bit of excitement back into that. There, you can look at it.
OK, I'm quite excited. OK, there's Blackwell, the kind of the Blackwell Ultra's coming, but Rubin's coming as well.
Yeah.
So Rubin is the technology for next year, and he needs to talk aggressively about Rubin to keep the kind of the show on the road. And to Lizzy's point, maybe that's sort of faltering a little bit right now, but Rubin feels like what we need to hear about. The next gen, what's it going to do? How does it keep people spending?
But also the shipping constraints that come with it. You talked about Blackwell there. Blackwell has just started shipping, and that was the kind of highlight of last year. Rubin was the latest, and everyone's watching it, but it's not expected to start shipping until next year. So you have this massive delay that the markets are kind of overlooking here, and it kind of feels like in addition to the next product, we've talked about the delivery of that product.
But it's always about next. The market's a discounting mechanism. It's not about now. It's about this is how you price these stocks. It's further down the road.
But the markets are pricing something in, 6-9 months ahead of the road. We're talking about 2 years down the road. That is the time gap is just getting bigger and bigger for Nvidia.
But if we are seeing huge step forward in terms of the technology, is it enough to keep costs low for the hyperscalers that are bringing kind of the technology to market? They need this stuff to become much more efficient if they're going to make the economics work. Anyway, it is something that we are going to watch very, very... It's a huge week, another massively volatile week coming up. There's plenty of other stories you need to be focusing on as well this morning. The UK government is planning to cut the number of regulatory bodies and reduce welfare spending in order to boost stagnant economic growth. Chancellor Rachel Reeves is bringing 8 of the UK's main regulators to Downing Street today to discuss her plan to reduce regulatory costs on business by a quarter. The government is also expected to unveil plans on Tuesday to cut the welfare bill by up to £6 billion in an effort to encourage more people to return to work. France's Prime Minister has ruled out bringing the retirement age back to 62, citing the financial situation of the pension system in France. Bayrou, who opened talks on revising the pension law that is gradually, remember, raising the minimum retirement age to 64, now says a single minimum age may not be the way forward, i.e. sector by sector, maybe the way he goes on this and gets around it. France's state auditor has warned the pension system deficit is set to widen sharply in coming years. Without changes, it could reach €15 billion in 2035. And Iranian-backed Houthi rebels have claimed responsibility for a second attack on a US warship in the Red Sea. The group says this is in response to the US airstrikes in Yemen, and the group has vowed to continue the operations until the Gaza aid blockade is lifted. Meanwhile, the US has warned of, quote, unrelenting strikes until the group stops shooting at vessels in the Red Sea. This is having an effect already in terms of, A, what is happening with shipping costs, but the price of oil is reacting to this as well. Yeah,
today.
Yep.
So you've got that, you've got the China story, but on the flip side, if you look at oil, this year is down more than $10 a barrel from January's high. You had Goldman lowering their forecast for the year yesterday over the weekend because of all of the factors on the other side of the
demand side, basically.
Yeah, you've got, the tariff story, you've got OPEC Plus increasing supply, and maybe an end to the war in Ukraine. And as we say, we'll get more news on that potentially tomorrow.
Absolutely. This brings me back to the conversation we had with Trafigura actually around this table that said that the biggest risk that they're watching is not the tariff story, it's not the growth story, it's ultimately Iran's response when it comes to what happens. This is a direct kind of almost poking the bear, if you will, in terms of seeing whether or not Iran will come to the aid of the Houthis, given this latest escalation.
Keep supplying them, keep giving them the kind of kit that they need in order to continue to be attacking these ships. They're trying to hit US warships, which is hugely significant at this moment. But shipping costs, we've seen the inflationary effect of shipping costs. There was some expectation maybe that would start to come down as we saw maybe the Red Sea reopening, but it looks like going around the Cape is probably going to be the plan again for the foreseeable future.
Certainly something we're going to be keeping a very, very close eye on. All of this kind of feeds back to the inflationary impulse, to the fiscal spend impulse. That's going to be the major theme running throughout the show today. Let's talk about what's coming up. We're going to take a closer look at the European luxury stocks after China retail sales came in ahead of expectations. Will Beijing's push to boost consumption have a read-through into the sector? We're going to dive into it. Plus, the Bank of Spain governor and ECB governing council member Jose Luis Escriva says it's now impossible to predict where Europe's interest rates will go. More from that exclusive interview later in the program. But up next, we're joined by Sabrina Kanish, senior economist over at Pictet. We're going to talk about that fiscal impulse from China, from Germany, perhaps even from the United States. How does it all feed together? That is a conversation we're looking forward to having. If you have any questions for us or for our guests, dive into the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
US Treasury Secretary Scott Bessent speaking on NBC's Meet the Press over the weekend. He ain't worried. He's not worried about this stock market sell-off. It's a healthy correction. Where does that leave us? Well, probably a little bit more on the back foot than we first thought going into this weekend. Let's figure it into this week after the weekend. Let's figure it all out. Bloomberg's Valerie Satel bringing us all together.
Guy, that's right. Equity markets are starting this week on a back foot after it seems like the market correction is not softening language out of the Trump administration when it comes to tariffs, when it comes to economic policy moving forward. S&P futures, NASDAQ futures down 0.7%. The market is questioning what is it going to take this week to snap those 4 weeks of losses that we had from the S&P 500. Could perhaps a dovish Fed decision change the tune for the equity market? They're widely expected to hold rates steady on Wednesday, but the devil's going to be in the details, Guy. They're going to be releasing their summary of economic projections alongside their dot plot. What kind of message will they try to weave with those projections? We also might get a potential update when it comes to balance sheet runoff and QT. But the Fed is just one of the various central banks meeting this week. Here in Europe, we also have the SNB, the Riksbank, and the Bank of England all coming out with rate decisions in the later half of this week.
It's going to be a massive week. There's so much going on. Potential Putin talks between the United States and Russia, one factor. You've also got this key German vote. So much for the market to get its arms around this week and figure out what is going to be happening next. Let's try and short-circuit that conversation. Sabrina Kanish, senior economist at Pictet Asset Management, joining us this morning around the table. Sabrina, nice to see you. So much going on this week. Barely know where to start. Let's start, though, with Germany. You've got Trump-Putin talks taking place, potentially resolving the Ukrainian crisis. We don't know what's going to happen. You've also got this key vote in Germany taking place, which could push through this huge fiscal expansion that we are going to be seeing in Germany, and the impact of that for Europe, absolutely massive. But you've also got Trump talking about tariffs as well. So I want to kind of fold all of this together and try and get an idea of kind of where we are. German fiscal expansion, huge. Trump tariff story, huge as well. Does one offset the other? Is that the way I should think about it from a European economic point of view?
That's a very good point, actually. At the start of the year, we were very concerned about the trade war, which was clearly a key downside risk on the Eurozone economy, as also mentioned clearly by the ECB. But at the same time, we had this huge fiscal expansion coming out for Germany. It is still very early days, so we need first the approval by the parliament. We know that a two-thirds majority is needed, which it has. So therefore, this large fiscal stimulus will be implemented with possible strong positive impact on the economic activity. But at the same time, we saw that Trump administration is very committed to its economic agenda going forward with the tariffs. EU has retaliated with measures set to be with tariffs the 1st of April and should be followed by mid-April. The direct impact is so far limited, given that Eurozone exposed to US account for 3% of GDP. But what we have to consider also is the indirect impact, higher uncertainty, lower private investment, as well as higher precautionary savings.
What do you think the ECB is focused on? It feels like they're focusing more on the Trump side than the German fiscal expansion side.
That is true. When we look at the recent ECB press conference, clearly the focus was on the downside risk and the impact of the trade war on the economic activity. But recently at the ECB Watcher Conference, Lagarde mentioned that in this environment of high uncertainty, the commitment to price stability is even strong. She mentioned also that large shocks have persistent effect on inflation, and the risk is the incurring of inflation expectation. So obviously we know that the Trump tariffs might be inflationary via the euro depreciation, making US-denominated goods more expensive, and we are in this environment of sticky prices. So it's not easy. It seems that for the time being, they are concerned about the trade war, but also the commitment to price stability. And the announcement from Germany is very positive, but it's still very early days to them.
Okay.
Sabrina, let me take a contrarian approach, though. Plug holes in your argument if I can. We're talking about this massive fiscal push from Germany. The math doesn't math to me. Let me walk you through my thinking. If we're comparing this to the likes of the Marshall Plan, for example, back in 1947, I'm doing a history lesson on international TV right now. The numbers then was about $13 billion coming from the United States into Germany. The fiscal spend of that in today's terms are trillions of dollars. That was over the span of 4 years. We're not talking about $500 billion over 10 years. That feels like less than the Marshall Plan, in theory. Why are markets so excited about that? And not just excited about the prospect, but excited about the delivery of that. That feels like the numbers are falling short.
But this is a fiscal U-turn, so it comes after 20 years of fiscal constraint. So just to keep in mind that the debt to GDP was 80% in 2008, and this is when Germany decided to write in the constitution the debt brake rule, and since then the debt to GDP has reduced by 20 percentage points. And we are not talking only about the 500 billion euro for infrastructure spending, which is usually have a higher fiscal multiplier, but there is also a deficit allowance for states of 0.35% of GDP, and also an exemption from the debt brake rule for defense spending in excess of 1% of GDP. So it's really a big package. It's a three-pillar fiscal plan with a possible very big impact on the economic activity. The reason one being that the fiscal multiplier could be very high, and this is due to the fact that the fiscal position is very strong in Germany, and the economy is operating below potential, and the ECB in this environment is expected to maintain a neutral rate.
You talk about the fiscal multiplier there. What about the consumer kind of trickle-down effect? If you apply, say, Reaganomics to this entire situation, does the German consumer impulse replicate that of the United States? So is that fiscal multiplier as fast as perhaps you would expect in other parts of the world?
Well, the fiscal multiplier tend to be high when we look at infrastructure spending. But you're right, usually there is a lack of implementation for those kind of fiscal policy. Infrastructure, usually it's more, it can be between 12 to 18 months. So overall, a lack of implementation between 6 to 9 months, even more. Now it's important that you are speaking about consumers, because we have to keep in mind that consumers and household and investments and companies, are sitting on a huge amount of cash. So they are precautionary savings that can be unlocked to boost private spending.
Okay, so that's the fiscal boost. Sabrina, I'm kind of getting frustrated every time I hear policymakers talking about the uncertainty and how they can't tell us what they're going to do because there's so much uncertainty around not just the policy itself, but the retaliation. How are you modelling the uncertainty around tariffs? Do you have more clarity on the potential outcomes than they do?
Unfortunately not. It's a very tough environment, as Guy mentioned before. So we have two opposing factors. We have the fiscal expansion that can be very positive for the economic activity, but at the same time we have the trade war. And when we have uncertainty, it's really bad for companies. They tend to postpone their investment decision in the future. And the same is true for consumers. If you look at Europe, given the energy crisis, households are seated on a lot of amounts of savings, and despite that, they struggled actually to use those savings given the uncertainty.
All right, Sabrina Hanish, senior economist in Pictet Asset Management, walking us through what that fiscal multiplier actually is. Whether or not the markets are actually pricing this in fully or even too far is another question. That's going to be something that we'll see how the ECB responds. And coming up, speaking of the ECB, Bank of Spain Governor Jose Luis Escriva, who is, of course, a voting member and an ECB counseling governor member on the ECB, saying it's now impossible to predict where European interest rates will go. This catch-22 of is the U.S. tariff growth impact going to be counteracting any sort of benefit coming out of Germany and the rest of the continent? More of that from that exclusive interview next. This is Bloomberg. 30 minutes away from the start of the opening trade. The futures picture fairly muted at the moment. Take a look at Eurostoxx 50 futures. They're basically, we'll call it down 0.1%, but let's not put too much emphasis on that. The outperformer this morning is the DAX futures. It is Monday morning. It's a cautious morning, it seems, and yet you still go back to the European playbook of Germany outperforming. Let's talk about the bond market here. It is 7:30, so of course we're going to get those initial reads when we look at the bond market. And we are seeing, again, very tiny slight bid into France. I think the French story is very interesting. We talked about it a few minutes ago as well in terms of Francois Bayrou, I should say, talking about whether or not he was going to make changes to the proposals around that pension age. We'll see if the markets react to maybe a little bit more in the equity market than the bond market. But for now, 355 on the French yield, 286 on the German 10-year. Let's stick with the European bond story. Perhaps the European rate story is more appropriate. Bank of Spain governor and ECB governing council member José Luis Escriva says it's now impossible to predict where Europe's interest rates will go. He spoke exclusively with me in Madrid last week. Escriva discussing the impact of U.S. tariffs on the rest of the world. Take a listen.
There will be primarily inflationary in the United States. In the rest of the world, including Europe, will depend very much on second-round effects and retaliation policies, which are still very difficult to anticipate. I would say that, if anything, what is coming for these trade policies from the United States is uncertainty, extreme uncertainty in terms of the impact on the various economies. In principle, they are inflationary, but at the same time, they might impact negatively on demand and confidence. And in this respect, the net effects in terms of a positive supply shock on inflation and a negative shock on activity, and in turn on inflation exerting downward pressure, is very difficult to go ex ante. So I would say, if anything, the situation has given rise to a very complex and unpredictable environment.
It's quite clear that the ECB is still very much on a cutting path with the uncertainty to provide that sort of safety and even just to come out of that restrictive territory. Does that create space for some sort of policy misstep? And I ask this in the context of the time we saw this in the first Trump administration, when the trade wars first came about. You saw global central banks, obviously the Federal Reserve, but right here in Europe as well, talking about insurance rate cuts. Is that the way to be thinking about the ECB's approach to specifically in response to the trade war out of the U.S.?
We are now far less restrictive than we were a few months ago, because we have already undertaken a significant correction from previous increase in interest rates. So now we are in a situation which is much closer to normal circumstances, and this has to be acknowledged. And from that, I mean, it's, as I said, at this stage, I would say we have to wait to see exactly all these policies or potential policies and second-round effects, how they really materialize, in which direction. It's very difficult.
Bank of Spain governor and ECB governing council member José Luis Escriva speaking to me exclusively on Friday. I thought it was interesting. He said, we have to wait and see. We have to keep and kind of give it a second to all play out. And I said, Governor, what's going to change in 3 weeks' time? What fundamental data is going to change? And he says the red flag is services inflation. He said the minute that drops, that's where kind of all bets are off, and that's where you have to change. But ultimately, he's saying the risks are skewed in both directions. The tail risks are super large. And ultimately, to me, that sounds like the market, it creates a gigantic realm and room for some sort of policy misstep.
Apparently, after the last meeting, during the last meeting, they spent so much time arguing over how they should describe uncertainty. Should it be phenomenal? But uncertainty is the word that just keeps on getting repeated from all of the governing council members at this point. And interestingly, Luis de Guindos, the vice president, over the weekend was saying that there's more uncertainty out of Trump's trade tariffs than COVID. But as you say, this is really the theme going into that April meeting.
But from a market point of view, you can price risk. Right? If you can get a handle on the parameters, you can kind of ascribe a number to that. Uncertainty, who knows what you're doing?
Well, it's interesting because the argument here is that the fiscal spend is great and could counteract the growth story. But what if you have inflation coming out of Germany, inflation coming out of the tariffs, and then
what if?
Sure.
But that's the problem.
But you can magnify that, so why not pause? It doesn't feel like anyone's giving actual weight to the idea of pausing just yet.
Exactly. This is what I'm tearing my hair out about at this point. But look, in order to pay for that defence spending on the fiscal side of the ledger that we're talking about, some places are looking at cutting their aid budgets. Now, Washington's US aid cuts are looming large over regions that depend on assistance, and it comes as global humanitarian aid is facing a period of acute challenges. You've got flare-ups in the world's geopolitical hotspots, Ukraine, Yemen and Gaza. Meanwhile, though, the European Union is hosting its 9th Brussels conference today under the theme Standing with Syria, and the aim is to mobilise international support for the country during its transition from the Assad regime. So I'm pleased to say now, joining us from Brussels is Tom Fletcher, Under-Secretary-General for Humanitarian Affairs and Emergency Relief Coordinator for the United Nations. Tom, really good to have you with us on this important day. It isn't just US aid that's leaving a void here. You've also got the UK cutting aid spending in order to fund defence spending. What are the consequences on the ground of those aid cuts?
So there are very real consequences because of the pace of those cuts and also the savagery of those cuts. There are hundreds of millions of people that we won't reach with life-saving aid in the coming year. So we're having to revise all of our plans, all of our strategies to save as many lives as possible with the resources that we'll still have.
And of course, migration has been key to the rise of right-wing political parties across Europe. That could be surely fuelled more by these aid cuts. What do you think?
Well, I think, there's a reason why aid is necessary. It's not just for ethical, moral reasons. It's also because it's upstream diplomacy, it's upstream security. Now, if you engage in countries and help them to build their economies, as we're trying to do in Syria over today and this conference here in Brussels today, then actually you deal with many of the potential downstream consequences of not engaging. Rise in insecurity, migration, terrorism, future pandemics, for example. So there is a pragmatic case for aid alongside what many of us would see as the moral, ethical case for helping the world's poorest.
Tom, good morning. It's Guy. Can we talk a little bit about what is happening in Syria right now and the conditions that those return will find? You've got over 1 million Syrian refugees in Germany. Around half claim benefits. There is an effect on the labour market as a result of these people's arrival in this country and their potential departure as well. Would you expect significant numbers of Syrians to return from Europe? What are you seeing? What would you expect?
So I do expect a lot of Syrians to be heading home. And in fact, we have a scheme up and running already where Syrians are able to go and take a look at the conditions to see whether it's safe to go back. And the Syrians I talk to, the vast majority want to go home. I spent a week in Syria in December and drove from the Lebanese border all the way up to the Turkish border to look at those conditions. Now, the biggest impediments to people going back are actually unexploded ordnance, and we're busy clearing that as we speak, but also the lack of power, which means that, it's harder to rebuild communities, rebuild livelihoods. If we can get those two things sorted alongside the basic humanitarian needs that I'm working on here in Brussels around food, water, shelter, medicine, then I think people will go back. And what Syrians tell me is that they'll go from being an importer of generosity and kindness to being an exporter, once again, of generosity and kindness.
Well, Tom, one of the criticisms, of course, of this, aside from the humanitarian approach and the humanitarian reasoning here of the U.S. aid pullback, and some of the reflections you're seeing in other European governments as well, is simply that this is an elimination of soft power and in terms of some of the Western governments and their reactions to the rest of the world. Are you seeing a tone shift at all in terms of that move, or perhaps more and more governments, more and more officials around the world leaning in to that messaging?
Well, you're right that overseas aid has been a massive part of the projection of magnetism and power, soft power, by countries like the US. It's been an enormous way to show that they are engaged with the world. And I think you don't build a golden age by retreating from the world. You build a golden age by engaging with the world, by leading the world. What we're seeing is that many other countries are looking to step into that space. I was in the Gulf a couple of weeks ago. I've been talking to countries in Asia and across parts of Europe where they're actually saying we need to scale up now to compensate for these pullbacks. And they're seeing the advantages of moving into that space and really owning that space. So my hope is that we're not going to see these savage scale of funding cuts that currently look like they're on the table. And I'm hoping that we can persuade those countries who are pulling back to see the benefit of what they were doing.
Let's talk a little bit about Ukraine, because obviously that's going to be in the news over the next 24, 48 hours. It looks like we're going to have a meeting between the US president and Vladimir Putin, a call at least. What is your assessment, Tom? And you are an expert in this space. You're currently focused on Syria, but I'm curious to see what you think the similarities with Ukraine will be and what your expectation will be for what that country looks like post a potential peace deal. Will refugees be returning? What kind of effect will they have? What are the situations that they're going to find on the ground? Are there similarities, lesson learned that we can take away from Syria? What are you expecting to see, and what do you think the kind of the prognosis is there for the Ukrainian economy, the Ukrainian people?
So they're very different situations. Of course, the Syria conflict has raged now for 14 years, and there is a massive amount of rebuilding to be done. Again, in Ukraine, as those communities go back, if there is a genuine peace, a genuine ceasefire, there will be a huge rebuilding program in the east of Ukraine. And I was there in January. I spent a week traveling around those areas on the front line. Again, people need food, medicine, they need shelter. Many have had their homes destroyed. Of course, the Ukrainian economy is at a more advanced stage anyway than the Syrian economy. And so you would hope that with that capacity, they'll be able to rebuild faster. Again, we've got big appeals, as we have for the Syria campaign right now, but we'll need the world to be generous there too. The lesson, I think, from both of these conflicts is that the costs of not rebuilding, the costs of not engaging are actually much greater than the costs of rebuilding and engaging, because you just kick the problem further down the road. So let's see what happens in the next few days. Let's see if there is a genuine ceasefire, or cessation of hostilities on the table that both sides can accept. And let's see if we can help people to rebuild their lives and get back to a more peaceful existence again.
Sounds all pretty good. Tom, we will follow events with a great deal of interest in what is happening in Syria over the next few days as well. Tom Fletcher, Undersecretary for Humanitarian Affairs and Emergency Relief Coordinator for the United Nations. Thank you very much indeed. While we keep one eye on what is happening in Ukraine and Syria, we keep another eye on what is happening in China. Officials in the country still speaking on efforts to boost consumption in their economy. We will bring you the latest out of that briefing. That's next. This is Bloomberg. Thirty minutes of the market open this Monday morning. European futures quite mixed, I would argue. Flat probably is the best description of what you see on the screen in front of you. US futures, though, are quite negative, which is interesting. Big rally Friday. We're fading that this morning. Scott Besson maybe partly responsible for the fade that we are seeing today. Let's talk about what is happening on the other side of the world as well. China consumption and industrial production data this morning growing at a faster clip than anticipated. Marks a positive start to the year. Of course, this comes amid all the tariff threats that are swirling at the moment. We're watching for headlines. Chinese officials currently briefing on a plan to boost consumption. Katia Dmitrieva in Hong Kong here to brief us on this. Katia, the market got very excited about this briefing on Friday. I'm wondering if it's living up to expectations.
That's certainly what we're seeing today in stocks. You had economic data that came in a bit stronger than expected, but not really going gangbusters. And then you also, as well, right now we're just watching, and the headlines are coming in on officials talking about their plans, or I should say lack of detail of plans on how they're planning to boost consumer consumption and retail spending. Those figures started the year looking pretty good, got a bit of a boost from the holidays. But one thing we haven't seen so far is a big shiny number for some of these programs, and also more details. My colleague Dan Murtaugh was there and asked a few questions, and in response, the answer was, we're looking into it. We're actually having officials drawing up plans and looking into details. And so the market's really gave up some of those early gains because it's sort of back to where we start every time with this, right? We investors are expecting a lot more plans and details on consumption, especially when Chinese officials are trying to reach for that 5% growth target again this year. And we just haven't seen that so far, at least not yet from this press conference.
Bloomberg's Katya Dmitrieva walking us through basically the main lines that we're hearing outside of the China story. We're going to come back to her, of course, if we do get some more. Let's talk about the broader markets, though, and get a little bit more perspective about what this means. Paul Dobson, Bloomberg's executive editor for Asia Markets, joins us this morning. Paul, we're getting this very positive data out of China, as Katya just mentioned. Is it enough? Is this a fluke? How are you thinking about it?
Yeah, hi, Kriti. I think that this briefing in particular is not really going to give the market exactly what it needs. You know, the expectations that have been built in for whatever reasons on Friday were quite high. All we really heard was some building out and incremental details of things that had been highlighted already a few weeks back at the MPC meeting. You know, the market really wanted a big billion-dollar number, really wanted a triple R cut, something like that to really get people excited and fire up further gains. Didn't really see any follow-through in any of that. Nonetheless, there are some inflows coming through. I think if you look at the Hang Seng today, for example, you know, 8 or 9 of the 10 biggest movers are the 10 biggest companies in that index, which points to this idea that it's a kind of portfolio inflow across the index rather than anything specific or that people are focusing on today. So there is that positive momentum, a little bit more international interest where people are allowed to invest into China. But really, you know, the data, still a bit meh, as many reasons to be negative as positive, and the policy stimulus measures still very measured.
OK. Strange noises coming out of Paul Dobson. Let's talk about what's going to move markets this week, Paul. What are you focusing on? Is it the Fed? Is it the data? Is it the politics? What do you think is going to provide the volatility impulse?
Yeah, I think the politics more than anything. I was reading our Fed story, actually, just before I came to talk to you guys, wondering what we were saying. I mean, my view is kind of the Fed doesn't want to get involved too much in the politics at this moment, partly because of the uncertainty and partly, you know, because it's supposed to be apolitical and perhaps, you know, there's this other idea, a little bit like the Bank of England didn't want to involve itself too much when Liz Truss was moving the UK markets a great deal, that, you know, leave this to the politicians and so they can find their own way. So I think we're still in that camp now. What Besson said yesterday on US television was quite interesting again. Investors responding to that a little bit by pushing down those markets. I think if you heard him out, a lot of what he says is quite sensible. It's about getting to grips with, you know, the US spending. It's about pricking a bubble before it gets too inflated. But the problem is that the market doesn't really want to hear that right now. It wants a little bit of reassurances on the economy, on consumer confidence, on the outlook and those kinds of things. And saying we're not too worried if there's a correction isn't going to help sentiment, particularly for the equity market this week.
I mean, we were debating before we came on air, Paul, whether it was really that disappointing that Besson had said this. Do you think, therefore, it is just a rotation?
I think that yes, we have a really good look at that in today's macro view column, talking about this idea that actually just better opportunities elsewhere. People leaning into that more, looking at Europe, looking at China, looking at other places to put your money. And so that just makes the US less appealing. But I think there is that genuine concern about tariffs and the impact on the economy as well.
All right, Paul Dobson, Bloomberg's executive editor for Asia Markets, we thank you. And now let's take a look at the stocks to watch with Joe Easton from our equities team. Joe.
Morning, Lizzy. So I've got my eye on the UK supermarkets today after we saw big drops in both Tesco and Sainsbury on Friday. These shares falling the most in several years. This coming after the rival, the privately held Asda, issued a profit warning related to pricing competition as they lose a bit of market share. And this really spooked the market here in London in late trading. But analysts at JP Morgan today saying that they actually see a buying opportunity because they reckon the fundamentals in this industry are strong. So they say people should be buying into this weakness. We'll see if those stocks rebound today. Then I'm also watching shipping. This as the US vows to strike the Houthi rebels in retaliation from them resuming their attacks on Israeli-flagged ships in the Red Sea. Now, this could potentially mean a resurgence in shipping rates, and therefore that could actually be a positive for these shipping stocks, given it would boost their earnings. Now, we have seen some volatility in the likes of Maersk and Hapag recently, so keep an eye on those two. Then in terms of Volkswagen, we have got news potentially of Porsche Automobile Holdings selling down its stake. They are the biggest shareholder, though there is conflicting reports with a recent headline out of Reuters questioning whether this is going to take place. But the speculation is that big shareholder Porsche Automobile might sell down some of their stocks. Keep an eye on that one today. It is one that is liked on the street with all those positive buy ratings. Then in terms of your analyst ratings, we've got Deutsche Bank downgrading the property stocks in its home market, Vonovia and Leg Immobilien. Telia is a sell in the telecom space at Nordea. And Kion, a maker of forklift trucks, is up to overweight at Barclays. That one could be positive in Germany this morning.
All right, our equities reporter Joe Easton walking us through, of course, some of the stocks that we could see moving at the open. I'm still concerned about this kind of China story, whether or not we're going to see a bigger impulse there coming out of that retail spend. Is luxury still the China playbook? Is that how you do it?
The focus was meant to be in the United States. We've moved away from talking about China. It was meant to be going to the United States.
But it's circling back.
Maybe the reason for that is because the US consumer, there are cracks starting to appear. If the market continues to roll over, a US consumer's going to be out buying luxury goods. Andrea Felstad's been on this programme on a number of occasions, also talking to crypto, talking about the fact that that could be a boost for the luxury space in the United States. Crypto's falling pretty hard as well. So all of these factors may be detracting from what we are seeing on the luxury story. Where does the boost come from? Maybe it comes from Europe. Heaven forbid, may I sort of dare to say that. US futures are pretty negative right now. I think we just need to fold that in. So anything we see at the European Open just needs to be seen in that context. Laurie Calvasina over at RBC cutting her target. She's still got 6,200 at year end, but she's down from 6,600, so still some headroom there. But a lot of caution out there maybe this Monday morning in the wake of what we heard from Scott Bessent too. European market is 5 minutes away from opening. We'll bring you that in a moment. This is Bloomberg. Monday the 17th, good morning, St Patrick's Day. A couple of minutes to go until the start of trading here in Europe. We largely priced in, actually, the big rally we saw in US equity markets Friday here in Europe. That's where we went out. That's where the US was at that point. There was a little bit of a pickup after that, so there's a little bit of a tailwind coming through. But what is interesting is that US futures have subsequently rolled over since then. They're still up on a two-day basis, but actually maybe the signal coming out of the States isn't quite so positive this Monday morning, Lizzy.
Yeah, and it seems, Guy, that more of the action is going to be happening on that side of the pond, because if you look at European futures this morning, they are pretty dreary, much of a muchness when it comes across the continent, and that speaks to the fact that the China press conference was a bit of a nothing burger, the fact that FTSE 100 futures are expecting about the same action across this screen. Kriti, maybe it's more about the geopolitics this morning.
Maybe a little bit more about the geopolitics, to your point, perhaps largely seeing the likes of shipping stocks of just one component, but there's plenty of individual stocks to look at as well. Of course, we're going to see if Maersk reflects perhaps a little bit more of the volatility, the news coming out of the Houthis over the weekend as well. They haven't really seen it reflected in oil to that extent. We'll see if that shakes out in just 30 seconds time. VW is, of course, very much in focus, as is AstraZeneca. I want to zoom in on AstraZeneca, though, because we know this is a diversification story when it comes to a lot of those pharmaceuticals. They are now looking to buy a Belgian biotech company for up to $1 billion. Does this help them kind of diversify, Guy, at a time when we know AstraZeneca is, of course, a very heavily watched stock when it comes to the FTSE 100?
Absolutely, one of the key stocks on the FTSE 100 on that index. Let's talk about all of the indexes, though, and give you some numbers. It is Monday morning. How are we starting? As Lizzy's indicated, fairly flat, but it's time for the opening trade. Is what we're looking at in terms of the flat futures going to translate into actual numbers on our screens? FTSE 100, as you can see. Yep, there we go, fairly flat. Absolutely nothing there. Lizzy talks about China being a nothing burger. The index indications coming out of Europe already this morning tell a similar story. We climb a little bit. We're up by 0.2%. We have to think about kind of a number of things as we look forward into this week. And it's so uncertain as to which one will provide the volatility. Could be the stock stories, could be the Fed, it could be the geopolitics, it could be what comes out of China. So much to think about in terms of what is happening here. Politics in Europe may be something to throw into the mix as well. But this morning, Lizzy, it's a cautious start. So what are we seeing, guys, in terms of the sector story?
Well, if you break it down, you've got about just over half in positive territory. Basic resources leading the gain, so that's up 0.8%. Healthcare just behind, up 0.4%. And if we just dig into some of those names, AstraZeneca, as you flagged, Kriti, is up 0.7%. We did have this news that it's signed a deal to buy the cell therapy specialist ESO Biotech for up to $1 billion. Basic resources, harking back to this China story. And if we zoom into the luxury picture, actually, you've got a lot of the names in negative territory this morning. So LVMH down 0.2%, Hermes down 0.5%. Burberry, though, up 0.9%. So a mixed bag off a mixed bag press conference.
Absolutely, but right off out of the gate, if we are looking for some sort of China impulse, you kind of hinted at this there as well. Rio Tinto, Glencore, the miners very much in focus for the FTSE 100. And I'm still waiting to see where that German optimism is. Maybe we'll get that in about 2 minutes' time, Guy. But at the moment, that kind of outperformance, the marginal outperformance, I should emphasize, that you saw in the futures picture, not evident at the open.
Absolutely. I think the German positivity comes in the form of what we've seen so far year to date in terms of German stocks. The huge pricing at the moment. If you look at the DAX, it's up by 15%. Comparing that with the US markets in euro terms, currency adjusted, the S&P is down. If you price it in euros, it's down by nearly 9% at the moment. That spread is just enormous. Can it continue?
Can actually catch up, but do valuations even matter is another piece of this equation. I'm also waiting for the tech story to play out a little bit as well. We're going to get the Nvidia conference later this week. Is there perhaps a buy the rumor, sell the dip element that comes into the rest of the week, or are we still waiting to hop in?
Yeah, I will say the shipping stocks are moving already, and you flagged this, Kriti. You've got Muller-Maersk up 2%, Kuehne+Nagel up 1.1%, DSV up 0.7%, and all this coming back to the US vowing to strike more over those Red Sea attacks on by the Houthi rebels on those civilian and military ships.
I just think there's huge amounts of uncertainty here.
Yeah.
And the potential for this to escalate is definitely there. You've got the Houthis being hit, but the Houthis vowing to hit more ships.
Yeah.
And it's uncertain. If you're a big shipper, do you want to send big tankers, big container ships through the Red Sea at the moment?
But of course, for them, it comes back to Gaza and Israel blocking the aid to Gaza. So it ties into an even bigger geopolitical story for the Houthis.
And of course, the Iranian impulse to respond to all of that. So the key takeaway here is caution. It's volatility. So how do you play it when no one knows what's happening next? Joining us now to perhaps answer that question, Vincent Mortier, CIO over at Amundi, joining us out of Paris. Vincent, a pleasure to have you on the program. Look, we were just talking there about what these vehicles of volatility actually look like when it comes to a world of our favorite word, uncertainty. Vincent, how do you play this market?
Yeah, good morning. I'm glad to be here. So indeed, the market has been very noisy. Many things happening every day. So I think we need to distinguish between the noise and the long-term trends and the fair valuation. So it is very fast and furious in a way. There has been huge repricings, huge volumes, but nevertheless there are some very important trends at play that we need to consider. And so to distinguish between very short-term positioning and more, I would say, strategic valuation and investment. And this is where volatility is also a great source of opportunity, in particular for active managers. So I expect more volatility. It used to be on rates, now it's more on equities, which is quite more normal, I would say. So volatility is here to stay, and I suspect it will bring many opportunities for people who are able to have some cash to be deployed and not to jump on the first news, but to have some fundamental valuation approaches as well.
Well, Vincent, do the fundamental valuation kind of metrics even matter at this moment? We heard over the weekend Scott Bessent, of course, the U.S. Treasury Secretary, saying corrections are normal. They're even healthy. Would you agree with that this maybe jitters we're feeling in the market is actually normal and healthy?
Yes, and I suspect it's only the start as regards the U.S. because, of course, it has started to correct. But, U.S. equities are still expensive at large. In particular, if you factor in new information. And it's fair to say that the U.S. economy is starting to slow down. There are more and more signs of weaknesses. So do you really want to buy 22 around times earnings next year for the US market when EPS growth is starting to decelerate and will be a single digit or even low single digit? And when there are new talks of potential recession in the US, it's not our core scenario, but it is something that starts to be factored in. So valuation will matter because earning growth will be less favorable than before. On Europe, we had a big catch-up from low positioning. So now I think we reached a kind of fair level. So what next is not totally obvious, as you mentioned before. What next catalyst for the European market? And so in terms of fundamental, I mean, in our mind, US is still expensive given the news flow. Asia is still attractive, and Europe is fair.
Okay, so Europe's still fair value. Vincent, you say we've got to wait, that there are going to be opportunities for those that are sitting on the sidelines. What signals are you looking for to get back into this market? Is it just simply the valuation metrics that you've just been discussing in terms of kind of what's overvalued, what's fair value, what's undervalued? What are you looking for, and how long should we be prepared to wait?
Yeah, I'm looking for two things. First, to get more clarity on where the global economy and the US economy in particular will go. Today, it's very uncertain. So as long as there will be uncertainty around, it's better to wait a little bit to have more clarity on growth, inflation, and geopolitics. Second, you mentioned valuation. It's a key, of course, a key metric. I don't believe we are yet at a point where valuations are cheap. So if you have the luxury not to be invested or to wait a little bit, there will be opportunities later on. We are only in March, so the year will be long. You mentioned metrics for the start of the year, which are quite extreme in terms of gap of performances. I suspect it will continue to be like this for quite some time.
How much downside, if you look at your tail risk scenarios, how much downside could we potentially see for US stocks? You talk about the fact that they're still expensive. Markets tend to overshoot and go through fair value and go to extremes. Is that the scenario we're looking at here? And what is an extreme scenario for you in terms of what US indices could be showing us?
I mean, today we are around 20 times earnings. I think in the given what we expect from the earnings and the economy, 18 times will be more adequate. So if you make the math between 22 and 18 times, all things being equal, the US market can drop by 20% easily. So it is a kind of drop I would expect before going back overweight US equities. I think today is too early, and at 22 times earnings is too expensive in my mind.
Vincent, good morning. Lizzy here. You mentioned Asia earlier. We had, of course, the Chinese data beating expectations this morning. We've had the Chinese press conference on more stimulus for consumers. Do you buy the idea of a Xi put if the idea of a Trump put seems to be fading? How do you balance the China story and the Europe story when it comes to investing?
Yeah, indeed. China has put together a plan which was expected in a way, a credible plan to boost consumption. It was the missing part in their strategy. I think China has a luxury to have time and have some ammunition also to support the economy. And I strongly believe that Xi is under big pressure to maintain economic growth, which is around 5%, because it is a condition for the stability of the country. And so as a result, I think he will do whatever it takes, to paraphrase now a famous sentence, he will do whatever it takes to boost local economy, local consumption, to incentivize people to spend their huge spendings, because China is a huge spender, is a huge savers. And so as a result, I think there is still some upside to be captured in the Chinese market, because of this tailwind, which is quite powerful. And again, I mean, they have time and ammunitions to make it happen. It is maybe a difference to the US.
Yeah. The other thing, Vincent, that interested me over the weekend was this report that US officials are threatening you may find the missiles stop working. Now, I feel like that is really serious when it comes to how European defence spending, increased as it's expected to be, will be spent. There used to be lots of scepticism about whether that money will be going to American defence stocks. Does it actually mean that European governments are forced to buy European if they can't rely necessarily on the US?
No, that's a very strategic and important question. So indeed, it is an interest of Europe long term to be self-sufficient in terms of military production. It is not yet the case. It takes many time to build credible capabilities. So a few countries are already quite self-sufficient in a way. France is a good example. But as you said, today, around two-thirds of the military spending from Europe is going outside the Europe, in particular to the US. That's a big sovereignty issue. So I think there will be some big pushes to re-internalize, in a way, this spending towards European makers. But it will take years and years because, again, you don't build such capabilities overnight. So it's a transition to be made. I think the willingness of European leaders to make it happen is strong. So I suspect there will be a support in this space to be more self-sufficient. But again, it will take many, many years.
Vincent, what kind of fiscal multiplier are you modeling out? What kind of expectation is there that's tied to this outperformance? What's the number? What's the figure when it comes to that fiscal multiplier?
Well, it depends on each and every project. If you take Germany, the infrastructure spending plan, which is very important as well, everybody's talking about defense, but the infrastructure plan is also very important, will have a high multiplier, so well above 1. So that can be a game changer for Europe because it will spread in terms of impact through Europe. So the infrastructure plan is the one really to monitor. The defense one, the multiplier today as we speak is way below 1 because of this foreign non-European spending. So this is why it's very important that Europe is able to build some capabilities to take over and to regain sovereignty in a way in this space. So we expect a much higher multiplier here, but long term, not short term.
Vincent, will you still be buying European defence stocks after the huge surge we've seen in their valuations?
It has been brutal in terms of price action. So now I would say these stocks are priced for not for perfection, but for something very big to happen. The issue is that yes, there will be more spending. Yes, there will be more business. Question mark is at which margin. And you know, government are careful spenders. So, I mean, will that translate into much higher profits? It remains to be seen because there will be tender offers, there will be competition. So maybe the market has been a little bit ahead of itself here for some reasons. But currently, valuations are a little bit demanding, maybe too demanding. So I would wait a little bit to have a pullback in order to reposition aggressively on this sector.
Yeah, we're seeing some of that this morning. Vincent, thank you very much indeed. Always appreciate your time. Vincent Moutier, the CIO, joining us from Amundi. Great to see him. Let's talk about the Core 6 and what we're watching here in Europe this morning. This is what the centre of gravity looks like in Europe. As you can see, there's a lot of red out there this morning, which I think is really interesting. In terms of the nuance, actually, I'm not sure there is that much. We're down kind of 0.75% pretty much across the board on a range of stocks this morning. Novo's popping higher. In fact, the pharma sector is firmly in focus this morning. But let's turn our attention to what is happening in the defence space. Kinetic has seen a huge rise recently. That is unwinding this morning. Why? Let's find out with Joe Easton.
So it is really playing into that theme you were just discussing a moment ago, guys, with these defence stocks having seen this big rise in valuations. Just a little bit of a warning from Kinetic in London has sent that stock sharply lower. They are talking about weaker than expected margins versus analyst expectations. It does seem to be the reason. This stock getting hit hard, down 15%, the worst performer. Also hearing it's feeding through into some of the UK defence firms as well. Rolls-Royce, potentially BAE Systems, a couple of those a little bit underperforming following that warning from Kinetic in London. Then in terms of the best performer today, Phoenix getting a big boost. The UK listed insurance and asset manager seeing some good flows and also benefiting from the insurance division as well. So really a strong report out of that one today, the best performer across the stocks 600. Then in terms of those shipping stocks, we do have our eye on those following the US vowing to strike the Houthi rebels if they don't stop with their attacks on ships in the Red Sea, seeing a little bit of a move higher. In these shares, potentially, we're going to be looking at the shipping rates, see if that feeds through into the market. But one part of the market that's seeing no relief is the UK supermarkets hit once again. Remember, we did see Tesco down another 4% today. Remember, that was down around 8 or 9% on Friday. It was the biggest drop in around 4 years. Sainsbury, I think, was the biggest drop in 5 years on Friday, and we're coming down further. This profit warning from Asda seems to be really stirring up the market. I haven't actually seen anything new out today, so it does look like a bit of continuation, even feeding through into M&S and Ocado. So really a rough couple of days for the UK grocery sector. Then in terms of the rating changes, Deutsche Bank cutting its view on a whole bunch of real estate stocks over in Germany. Vonovia, Leg, I believe, was cut, and maybe TAG as well. Those stocks getting a downgrade. They have seen a bit of a re-rating following the positive fiscal news out of Germany, so potentially a valuation call on those. And then back in UK retail, ASOS is an underperform today. This one over at Exane. They say the outlook is bleak for ASOS, the UK-listed fashion retailer. They're citing industry data saying they prefer peers like Zalando in Germany. They've got a 200 pence price target. See it fall into 239. Still some downside. ASOS, one of the worst performers as Exane cuts the stock this morning.
All right, Joe Easton from our equities team walking us through some of those early movers. We thank you so much. At the same time as the European Open, the U.S. pre-market has opened as well. Let me take you through some of the stocks we're watching there. It looks like a lot of the focus is going to be on the tech space. When you look at that underperformance story, thank you, you are going to see Lam Research down about 1.3%. The underperformance, it seems to be in that stock. But you're seeing it across in terms of volume, some of those major sectors. Intel, Broadcom, all taking a bit of beating. Slight outperformance from Nvidia, but not the kind that we are used to. Where you are maybe seeing a bright spot is in those quantum computing stocks, at least in the pre-market. A significant amount of volume there. Take a look at that, a 12% rise. We're only a couple minutes in to the U.S. pre-market. So that's going to be something we're watching, Lizzy.
Well, there's also green on the screen, Kriti, when it comes to Brent crude, higher for a second day, up 0.7%. We're going to dive into that next as the risks in the Red Sea grow. And, of course, China has vowed to boost consumption. We'll get more details on those moves coming up. This is Bloomberg.
Welcome back. Monday morning, European stocks are doing absolutely nothing. Not exactly the most exciting start to the day, but take a look at what is happening over in the States. You have a negative session potentially in prospect over there. The situation has got a little bit better, but US futures are still negative. Can we blame Scott Bessent for that move this Monday morning, Kriti?
Certainly isolated to the U.S., then, not really seeing it in the European session, as you point out. We are seeing quite a bit of movement in one particular sector, though, and that is going to be some of those shipping stocks. Take a look at AP Moller Maersk or Hapag-Lloyd as just two examples, higher by almost 1%, respectively. A lot of this coming off of the U.S. Ordering strikes when it comes to the Houthis in Yemen. Crude prices also rising marginally after those attacks were ordered. Let's bring in Bloomberg's energy reporter, Anthony DePaolo, from Dubai. Anthony, a pleasure to have you on the program. We thank you so much for joining us. Walk us through the impact here when it comes to what we're hearing from the U.S. administration.
Good morning, Kriti. Yeah, as you say, it's marginally higher on oil, That's because we have kind of seen this escalating tension in the Middle East for a long time now, and oil markets really have not reacted to it. But what we're hearing now from the U.S. is that they're going to keep this kind of relentless pressure on the Houthis until they stop attacking vessels in the area around the Red Sea, around the Bab el-Mandeb Strait that passes by Yemen. You know, it's a little bit interesting because we haven't seen many attacks recently, because the Houthis did say that they were stopping attacks when there was a ceasefire between the Israelis and in the Gaza war. And that, if I remind you, was the reason why the Houthis said they were starting up these attacks as a protest to that Israeli war in Gaza. Now, with some interruption of some food aid into Gaza, the Houthis did say they would again resume attacks, but we are seeing then the U.S. Forces taking those attacks, taking that first step on those attacks. The U.S. has been present with other countries in a naval effort to protect some of those vessels there. So we are seeing this moving a little bit more to the offensive rather than just the defensive.
Nevertheless, Anthony, here is a potential risk that could move the oil price to the upside, but there's so many dominant forces moving it to the downside at the moment. I'm assuming from a price point of view, it's hard to break away from that. You've got weak demand coming out of China. Yeah, it might pick up a little bit. You've got the European story, but in particular, you've got the US story as well. The US economy may be rolling over a little bit. How hard is it to fight that narrative at the moment for those that believe that oil prices should be higher?
Yeah, I mean, it's difficult, Guy, and it's been difficult over the past year because, as I said, we really haven't seen oil break out of a tight range even last year. When you talk about those risks there, one thing that we are hearing out of the U.S. administration is a lot of the word Iran. So they're talking about these attacks on the Houthis as a way to pressure Iran and to tell Iran, which is largely credited with supporting the Houthis, telling Iran that those actions need to stop in the region. So that is a potential area of concern if that does lead to any escalation. So the oil market will be taking a bet whether it is heading in that direction or whether that's another step to push the Iranians back to the table. In terms of weak economy, and in terms of weak demand and potential fallout from a trade war, these are the things that are really holding back the oil market right now, and that traders seem to think are the concrete measures at work here.
Yeah, I mean, Anthony, Lizzy here, good morning. Trump says that he's going to be speaking with Putin tomorrow. There could be something to announce out of those talks, he says. What's likely going to be the impact on the oil price? How much of a move could you see off the back of that?
Yeah, I mean, that really depends on whether that is a positive discussion. So far, we have heard pretty positive noises coming out of the administration when they do speak with the Russians or about the potential for talks there. So if there are some more positive moods coming out of that in terms of moving towards a ceasefire there, you would expect that a ceasefire would have some give and take in terms of potentially some sanctions coming off. So that's really the factor there that would impact that, whether the market sees some of those sanctions that are affecting the Russian oil trade coming off. So far, the general mood seems to be people are seeing less pressure on Russia, a little bit more pressure on Iran, Lizzy.
OK, Bloomberg's Anthony DiPaola, we thank you as we keep an eye on those talks tomorrow. And speaking of which, critical minerals mining firm TechMet wants to develop a major lithium project in Ukraine. And we're going to speak to the CEO and chairman, Brian Mennell, next. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session, and it looks like European equities are just about waking up. The Stock 600 up 0.4%. You're seeing a bit more action when it comes to energy. That sector up more than 1% this morning, off the back of oil being up, perhaps, as the US vows unrelenting strikes on the Houthis. That also is boosting the basic. We also have basic resources up on the same reason, and that sector is up 0.9% this morning. But that also comes back to the China story. So a lot to factor in this morning. But we can take a deeper look, Kriti, into the resources story when it comes to Ukraine.
Absolutely, they're very much in focus. Let's go in there next. Irish mining company TechMet, which is partly owned by the U.S. International Development Finance Corporation, planning to develop a lithium deposit in Ukraine. This all, of course, comes as the U.S. and Ukraine seek to finalize a resource deal. I'm pleased to say TechMet's chairman and CEO, Brian Manel, joins us now around the table. Pleasure to have you. Thank you so much for joining us around the table. Brian, walk us through the controversy here. I'll start with a very simple question. Are there critical minerals in Ukraine?
Ukraine does have a lot of potential for substantial production of a number of key critical minerals. There is existing production of certain metals and a lot of projects that have been subject to historical Soviet-era exploration that are likely to be commercially developable.
When it comes to that commercial development, though, what do you need to see to take that from potential to actuality?
Projects that have historical data need to be subject to further confirmatory drilling and feasibility study work before one can define the economics and justify investment in substantial commercial production.
We spoke to a guest last week, Amanda Van Dyke from Critical Minerals Hub here in London, who said actually the Soviet maps aren't good enough to really, in a modern age, take a viable view of whether or not there are the required critical minerals to make it economically possible. How good are these Soviet maps?
The Soviet exploration work geologists were generally of a very high standard. So while the data that we have from Soviet-era exploration is not easily translatable into the systems that we deploy today to define economic potential, and therefore you need to do some confirmatory work, the data is generally of a high standard.
She also said that generally in geology, what's there is probably there in greater abundance, i.e. what we've already discovered probably is there, and we can do more of it. What is there right now that is being explored that we should therefore assume that the geology tells us there'll be more of that could be taken advantage going forward?
There's some interesting lithium projects, one of which we've been engaged with as TechMet over the last year and a half in discussions with the Ukrainian government to prepare for the tendering and acquisition and development of that asset. And there are a couple of others. There is significant potential rare earth metal resources. There are existing production that has potential to be considerably bigger and more important in titanium, uranium. There's some graphite opportunities. So it is relatively diverse and potentially very significant in global critical mineral supply chain security terms.
So potentially very significant, but are we talking $500 billion worth of potential opportunity?
Very difficult to put numbers on it and very difficult to put timeframes on it. To an extent, the scale of development and hence the value that can be derived for the Ukrainian Natural Resources Trust that is being proposed in this Ukrainian-US deal is dependent on the scale of investment in exploration, feasibility study, development, and ultimately production of new projects. And that will follow the implementation of this deal.
Okay. I'm also interested to see, and tell me if I've got this wrong, but your investment partner is Ronald Lauder, the cosmetics heir, who reportedly planted the idea of buying Greenland in President Donald Trump's mind. What sort of opportunity do you see there for TechMet?
Greenland, again, is an extremely interesting territory from a geological potential point of view. There are mining operations and there are exploration projects underway, but it's just the beginning of what could turn Greenland over the coming years and decades into a very interesting mining jurisdiction. A lot of it is relatively early stage.
Can we just... 50%, is that the number that the US government holds in you?
Approximately, yes.
Does that give you an advantage? Does that... when we see this deal being put together in Ukraine, is that something that will allow you greater access? The US wants its boots on the ground. Does that include your company?
Clearly, TechMet is in fact unique in as far as having been the recipient of direct US government equity investment, and therefore we have been through the system in the US since we first received US government investment in 2020 and with a number of follow-on investments, and therefore we are somewhat authorized by the system.
Yep.
And we do see ourselves as a critical minerals supply chain security champion of the US government and of US interests and the interests of US economic allies. So we are a natural participant, whether we have some sort of competitive advantage relative to other people.
Do you think you do having a competitive advantage?
We have some degree of preferential access, yes.
Okay.
What about Russia? Would you be wanting to mine there if Putin allowed?
Russia is a very important mining country with massive strategic resources, existing production and technologies. So it is important to the global critical mineral supply chain landscape, particularly vis-a-vis China, who has overwhelming control across global supply of all of these key metals. So Russia's interesting. I have no personal experience of Russia. The normalization of relations with Russia that would allow for investment and development of non-Russian companies with respect to Russian resources is speculative and some way off. So, you know, we would have no interest in at the present time. That may change in the coming years.
You talked about the scale of investment and this potential that you're seeing in Ukraine and in other parts of the world. What scale of investment, what level would entice or create the U.S. government to create security guarantees? Is there a level in mind? Is there an amount of investment or an amount of scale in mind?
The implementation, or at least the mechanisms and structures to implement the deal, which we expect to be signed in the coming days, remain to be defined. And therefore, the mechanisms of stimulating investment in these resources to build scale and hence value for the structure that is envisaged remain speculative. So in the short term, one's talking with respect to individual projects of millions. And in the medium term, you're looking at hundreds of millions or billions in order to commercialize resources that could be developed on a large scale.
Let me ask you this in a different way then. To accelerate your investment, are there security guarantees you've asked the U.S. government and the Trump administration for?
Clearly, to invest in mining is a long-term business and a capital-intensive business. In order to justify large-scale investment in mining, you require comfort with respect to long-term security and stability. So whatever happens in this space will require sustainable peace.
Brian, great to see you. Thanks for stopping by to see us. We're going to watch this carefully over the next few days. Brian Manel, TechMet's chair and CEO. Coming up, we're going to turn to what is happening in the United States. Scott Bessent isn't worried about the stock market slide as he doubles down on President Trump's recent attempts to play down the market reaction to the ongoing tariff and economic policy story. We are going to get the latest with Barclays' chief US economist. He's next. This is Bloomberg.
Welcome back to the opening trade. About 42 minutes into today's session, seeing green on the screen, a real departure for what you're seeing in the U.S. session, as Guy pointed out earlier. Stocks Europe 600 higher by about 0.5%. The DAX and the CAC Iran outperforming the FTSE 100, not by a massive margin. We'll see if these gains certainly hold, because at the top of everyone's mind is going to be what is the impact from the volatility story out of the United States, the tariff impact, and married, or perhaps in contradiction, to the fiscal spend story out of Germany and elsewhere. That was the conversation over at the Bank of Spain on Friday. I spoke exclusively to the Bank of Spain governor, ECB Governing Council member Jose Luis Escriva, who said that the ECB's central scenario faces big risks in each direction. Take a listen to that conversation.
There will be primarily inflationary in the United States. In the rest of the world, including Europe, will depend very much on second round effects and retaliation policies, which are still very difficult to anticipate. I would say that, if anything, what is coming from these trade policies from the United States is uncertainty, extreme uncertainty in terms of the impact on the various economies. In principle, they are inflationary, but at the same time, they might impact negatively on demand. confidence, and in this respect, the net effects in terms of a positive supply shock on inflation and a negative shock on activity, and in turn on inflation exerting downward pressure, is very difficult to go ex ante. So I would say, if anything, the situation has given rise to a very complex and unpredictable environment.
It's quite clear that the ECB is still very much on a cutting path with the uncertainty to provide that sort of safety and even just to come out of that restrictive territory. Does that create space for some sort of policy misstep? And I ask this in the context of this time we saw this in the first Trump administration when the trade wars first came about. You saw global central banks obviously the Federal Reserve, but right here in Europe as well, talking about insurance rate cuts. Is that the way to be thinking about the ECB's approach specifically in response to the trade war out of the U.S.?
We are now far less restrictive than we were a few months ago, because we have already undertaken a significant correction from previous increase in interest rates. So now we are in a situation which is much closer to normal circumstances, and this has to be acknowledged. And from that, I mean, it's, as I said, at this stage, I would say we have to wait to see exactly all these policies or potential policies and second round effects, how they really materialize, in which direction. It's very difficult.
So how
at this stage to commit to anything.
But I think the question here is also whether or not, simply because we've seen elements of this in the past, whether a policy misstep is in the offing simply because of the inflationary risks that you've just outlined. I think the concern here, though, is that perhaps the ECB is heading to neutral too quickly, and if that's a problem. Is it fair to even ask that question, whether the ECB is still heading to neutral? Is that still the goal?
Well, the concept of neutrality is a diffused one. I mean, I wouldn't, in a way, when we examined what should be the appropriate monetary policy stance at every moment, this requires an examination of quite a number of elements of the environment, of the economic environment, and whether this implies or not to be in a neutral, complete neutral position, I think is not the way I would approach it. First. Second, what we should convey to the general public is that we normally work under a central scenario with the projections over the next 2 or 3 years. This is our anchor for our decisions, but sometimes the central scenario is less likely to materialize, or the likelihood to be attached to it is sometimes larger, sometimes is not as large as we would like, because the uncertainty and the risk to the central scenario is very significant. I would say this is precisely the current situation, in which the risks to the central scenario on both directions are larger than normally. And in a way, I know that sometimes it's not easy for us to recognize the limits of our capacity to predict the future, but it's that way. I mean, the environment in which we have to make decisions is that way. And it's honest, I would say, and humble to tell to the public, look, now the situation is particularly complex, and that's the reason we have to really avoid committing ourselves to any future path.
Bank of Spain governor and ECB governing council member as well, Jose Luis Escriva, of course, there. An exclusive conversation with me in Madrid last week. I thought it was fascinating because I kept asking him, and he loves to use the word humble, I kept asking him, if you are dovish, are cuts a response to perhaps tighter financial conditions you're seeing in the markets, a.k.a. higher German yields, stronger euro? Does this kind of dovish mentality counteract that? And he kind of started to give way, and he said, well, it really depends on the tariff impact, because they still can't figure out, are tariffs inflationary or a hit to growth? And they can't, that's the math they can't do.
And the problem is that that's such a huge part of the puzzle, isn't it? Dovish hawkish, it feels like that's a relatively small kind of band within the middle of the overall debate. Yeah, I'm dovish, I'm hawkish, but yeah, I'm going to cut by 25 or maybe a little bit less, or maybe we'll kind of hold. The impact of tariffs and everything else just kind of, that's the rest of it. And the amplitude there, the potential swings are just huge.
I think you got to the absolute crux of the issue for the ECB, Kriti, in that it is, does the tariff impact offset the fiscal boost when it comes to growth? I think it's interesting in the Spain case that actually, if they're increasing defence spending, actually they don't spend that much on defence anyway.
Yep.
They're only committing to spending 2% of GDP on defence by 2029. So when you talk about that fiscal multiplier effect, it doesn't really mean a lot in this context of Spanish growth.
No, exactly. And Spain has a different issue with housing and immigration. Their issues are actually more similar to that of the United States than otherwise. I should mention that as we were speaking, of course, we heard De Guindos over at the ECB saying something very similar as well, that inflation will meet the ECB 2% target, but he's highlighting potential pain when it comes to things like deficits and debt issuance. So that's another factor to include as well.
Well, we've got a lot of data on the agenda for the week to consider from the ECB's perspective, but also from the Fed's. US retail sales out today, the Nvidia conference happening as well in California all week. Tomorrow we get German ZEW numbers, Germany voting on the debt brake tomorrow as well. The central bank palooza, BOJ and Fed on Wednesday, the BOE on Thursday and the SNB. And then Friday we cap it all off with Japanese CPI.
Let's talk about the Fed. Let's talk about what's happening in the US economy and try and understand what is happening there. Mark Giannoni, Chief US Economist at Barclays, joining us around the table this morning. You're quite pessimistic on the outlook. You're probably more pessimistic than most. Why?
Well, thanks for having me. We are quite pessimistic because we think that President Trump has been more willing to put in place tariffs than we initially had thought he would. So far, we've seen already tariffs put in place on China. We've seen tariffs put in place on aluminum, on steel, and a lot more is likely to come by April 2nd. The administration has announced so far. And then we think that the discussion is going to continue, and we'll have retaliation that's going to hurt the U.S. economy as well. And even without all of these tariffs coming in place, we've seen a surge in trade policy uncertainty.
Yep.
And that's likely to affect households in the near term and longer term. So we expect actually growth to slow meaningfully from what we have seen in the past 3 quarters.
Okay. Is this, so the US economy was showing some signs of weakness. Like there weren't a lot of them, but we were beginning to see maybe the cycle beginning to roll over a little bit.
Right.
It feels like what we're talking about here is pro-cyclical, i.e. they're speeding up the rate that the cycle is going to deteriorate at. We've seen this in the past. I can get back all the way into the kind of late 20s. Obviously, that kind of didn't end particularly well. We've seen other instances of that further on. How much is what Trump is doing turbocharging what we're seeing in terms of the rollover of the US economy? What's the kind of the beta effect, if kind of on the economic data?
Yeah, no, I think you're exactly right. I mean, if you look back at where GDP was growing overall over the past year, we are talking about more than 2.5% growth. Q4 was 2.5% growth, and we had several quarters last year where we had over 3% growth. What we are looking at now is a substantial slowing. We are not anticipating any recession, but we could easily see growth go below 1% this year. We are actually expecting 0.7% by the end of this year on a Q4 basis. So a lot of that is due to the tariff, the trade policy uncertainty, as well as restrictions on immigrations.
But what if Trump brings his tax cuts forward? Your outlook is more stagflationary now, but how would that reverse it?
Well, you know, when we talk about the tax cut, a lot of it is the extension of the Trump tax cut from 2017. So even though that's going to add to the projected deficits, because the deficits so far were projected on the assumptions that the Trump tax cuts from 2017 would be reversed. But now we are going to see an extension of this Trump tax cut. Now, for the everyday person on the street in the U.S., it's not going to change their life. So we don't expect much stimulus from that so-called Trump tax cut this year.
And so when it comes to the Fed, you've also changed your outlook there. You're now looking at 2 Fed cuts this year. What happens if inflation stays stubborn and the economy weakens? Is the picture even more, if the picture is even more stagflationary, what happens to the Fed?
It's very difficult for the Fed. This is a very difficult shock that they are facing. It's a trade-off shock. You have much higher inflation, you have lower growth, likely associated with a rising unemployment rate. So they'll really have to trade off these two. And it's going to come down to the magnitude. You know, is the inflation going up a lot more than they had anticipated, which we think they will have to revise up their inflation projections, and to what extent do we see a deterioration on the labor market? So on net, we anticipate that the Fed will cut twice. We don't think that they will show in their dot plot 2 cuts this week. They will want to be hawkish. And the main reason for why they want to be hawkish this week, I think, is that if you look back at what we had last Friday, the University of Michigan inflation expectations, that surged to a level we haven't seen since 1993. This got to send chills down the spine at the Fed.
If there is a hawkish impulse at any point from the Federal Reserve in response to tariffs, do the market conditions, do tighter financial conditions do the job for the Fed?
They do to some extent, and we've seen a pickup in long-term yields over the past couple of weeks. We've seen some tightening in financial conditions, if you want, but they had eased before. So financial conditions are doing their dance here in anticipation of what the Fed is going to do, and in response to all the news about tariffs in particular. But we think the Fed now is on a holding pattern in the near term. It's not going to move rates like this week. It's not. We think it's unlikely to move them even in May, as it awaits new information that resolves that uncertainty.
Well, speaking of that new information, you talked about a weakening labor market. Are we setting ourselves up for quite a bit of concern come April payrolls report, largely from the release of or the termination, large-scale termination of federal workers? Is that when that data point shows up?
Yeah, so we'll see. We'll expect to see some effect of that in the March print that we'll have early April. We expect some more negative news to happen potentially in the June print and then in the October print. So there are these discrete points in time this year where we're likely to going to see some disruption or some reduced job numbers due to the government employment and DOGE effect. Now, that said, there's a lot of uncertainty as to who is going to be laid off and how many government employees are going to be laid off. And the courts are still working through that at this point, and we'll have to see ultimately.
I got 30 seconds. Retail sales later today. Right. Are we going to start to see the stock market sell-off impacting upper-end spending? Does that in any way show up today?
We expect a rebound on the headline retail sales print because we had a very weak January print.
Yep.
So we expect a little bit of a rebound there, a 0.7% increase. We expect the control group, which is relevant for underlying consumption, to show a modest increase, barely in line with inflation. But that said, we think a lot of that might reflect some front-loading of spending still before the tariffs come in.
Great to see you, Mark. Thanks very much for stopping by to see us. Mark Giannoni, Chief US Economist, joining us from Barclays. We've got a conversation coming up with the FTC Chair, Andrew Ferguson. You can catch that 3:10 p.m. UK time. That is it for the opening trade. Hope you enjoyed the Monday show. The brief is up next. This is Bloomberg.